Good evening, ladies and gentlemen. Welcome to lesson number 2 of Forex trading. Today I'm going to be focusing on the basics as well, just to equip people on how to analyze. And today I'll be focusing mainly on technical analysis. So I'll be focusing on technical analysis, commonly known as price action. Most people know it as pure price action. So this is where we analyze the market using candlesticks. We figure out where is the price range. So we look at when we analyze, we look at price range, and we look at your demand and supply zone. Is the demand and the supply zones. This is where price gains momentum. This is where price gains momentum, either in bullish, that is the demand, or in bearish, that is the supply. Either in bullish or bearish direction. So the second thing that we need to identify the trend, right? We need to understand what trend or what direction are we facing of the trend, right? So the trend can either be bearish or it can be bullish. Another thing to figure out when trading is, remember I just spoke about the trend. You need to understand where is your trend facing, right? From there, how you figure out which trend you're on. You look at your trend line. You look at your trend line, right? The properties of a trend line also, just to discuss them as we move along. Trend line. We need to also look at the properties of a trend line. So a trend line has a start and the end. Basically, I don't want to underline anything. So the trend line has the start and the end, right? Mostly these are called support and resistance levels, right? The support and resistance levels are basically areas where there is major price rejection after a strong consolidation. Or if you want to understand it better, is where the demand and supply kicks in. You see, so this one you can further figure it out. I mean, your area of support and resistance, these two, you can further figure it out by looking at the number of, I'm just gonna plug in the charger, number of the candlesticks rejection, mostly in higher time frame. So not that you won't have a support and resistance on a smaller time frame. Obviously you will do. It's just that support or resistance on a smaller time frame, it won't be as strong as the one that is on a higher time frame. So it's simply just trying to find a way. But okay, on a smaller time frame, I can have minor rejections. On a higher time frame, I can have major rejections, which could determine my trend direction. So you look at the number of candlesticks rejections. Mostly on higher time frames, you look for 2 or more candlesticks rejection. You look for 2 or more candlesticks rejections, you see. So let us recap. What do we look at? We look at the price range, right? How is the price moving? Here we are going to factor the support and resistance and the demand and supply zones, right? And another thing that we can factor is the Fibonacci. There's a Fibonacci tool. There's a Fibonacci tool. It's either for the retracement or the expansion. What did I write? Fibonacci, okay. So you can either use to check where price rejects or where price supposed to continue, the Fibonacci price action tool. So it's easy to read once, but yeah, at the beginning it might be a bit difficult to apply, but once you've gotten used to it, it gets to be easier to read, you see. So you understand pure price action. And another thing, one major thing that most people won't tell you out there are price levels, right? Price levels which control the movement. Either the movement of a currency pair or a movement of a commodity, whatever it is. Let me just, okay, fine. This one, the price levels which control a movement, these ones, once they are broken forever, like they're broken for some time. So those ones you normally, you either sell 50 pips above or buy 50 pips below. This is just to be safe. It's to be safe and to allow the market maker to create liquidity in the market. We will talk about liquidity a bit later, but not in this video. We'll talk about liquidity when we are talking about the market maker strategy. So basically right now, I'm just introducing you guys to how to analyze the trend, how to make sure that you understand the trend. So technical analysis involves quite a lot of factors, right? Others, they can use technical indicators, right? I also do use some indicators myself, but I don't rely on them as much, because indicators can really mess up with what you think there must be and with what you think there is. So you just need to be careful when you're applying indicators. You need to be careful and you need to understand them in a more reasonable way of understanding things. So I would urge you guys that you may only apply technical indicators when you're sure of what you are doing, right? It's really advisable that way. So good people, back to what we were discussing, right? So technical indicators that I'd advise is an RSI, which simply stands for Relative Strength Index. Relative Strength Index. The default settings are your 70 and 30 levels, right? This shows you the price where the market has oversold and overbought, basically where price is getting stronger or weaker, right? Either it can be a bullish direction price or a bearish direction price, but where price is getting weaker, this will indicate that to you. So you just need to be careful on how you understand it or how you use it, right? The relative strength index. Another one that which I would advise for people to use is the MACD histogram. MACD histogram, this analyzes perfectly the convergence and divergence of the market, right? When the market is converging, right, I'm just giving an overview explanation of this. When we say the market converges, it's convergence. When the market converges, it's basically when we have a downward direction or a bearish histogram, right? MACD histogram. It's when we have a bearish MACD histogram and a bullish trend. No, I'm saying it the other way around. It's when we have a bullish MACD histogram and a bearish trend, and the market will converge. Convergence meaning that we are going to gain a bullish momentum. So this tool is useful to understand the change in the trend direction, right? The second one now that we need to look at is divergence, which is the opposite of that. It's when we have a bearish MACD histogram and a bullish trend, a bullish trend. Otherwise, you can have bullish divergence or bearish divergence just to avoid using convergence and divergence. So it's easier that way, right? So I will show you in a real application so that you can understand, right? So these are all the technical indicators that I would advise. Another one that I can advise is the use of moving averages, EMAs, or let me just say moving averages. You can use an EMA mixed with an SMA. SMA is simple moving average. EMA is an exponential moving average, right? I'll get to them, these ones on their own later on a video, right? So now, talking about technical indicators, these are the ones that I would advise that one can use. You can also add alligators, right? They also work, but they don't confirm on a bigger scale trend direction. But yes, they don't tell you the trend direction. They can just confirm you because, excuse me, because they change with the trend, right? They don't predict the future. They change with the trend. So you are the one to predict what is going to happen in the market with the tools that I'm going to give you, right? So in the beginning, I spoke about the Fibonacci retracement tool. So with the Fibonacci retracement tool, you will need to apply it in a manner that is understandable and easy. So this tool was found a long time ago. So it identifies identifies price levels of retracement in a given range. Remember when I spoke about price range, right? So Fibonacci tool is more useful when you apply the Cortez theory. The Cortez theory, which says that in a given 1000 range, right, you have price changes in 2 quarters, meaning on a 750 and 250 level, right? That is where price gets to change on a 750 and a 250 level. I'll just show it on a, in fact, let me just go quickly on it. This is what? This is Euro odd. We can go back on a 4-hour time frame, or we can just find something better because the market has been a bit choppy lately because of the coronavirus. This is what? This is USDJPY, right? According to the Cortez theory is that if I have this price level over here, at the bottom over here, and I have the highest price level, which is the high of the day over there, right? So these two price levels, the one there, in fact, let me make it more attractive color. Just make it yellow. It's yellow, it's fine. The price over there and the one here, according to Cortez theory, is that I must apply my Fibonacci retracement tool. You can get it here on the MT4 account. Then I will drag it from the low of the day to the high of the day. Therefore, I must identify my Fibonacci 50% retracement level, which is here. And then I must also identify, in fact, let me just use the shapes so that it can make it easier and more visible. I must identify it, which is over there. I like zones because zones, they depict correctly the price level. So the Fibonacci, the 50 Fibonacci, 38.2, 23.6, 61.8, 78.6, and 88.6. Therefore, I must identify my low of the day that is there and my high of the day, which is there. So it tells me, the Cortez theory tells me that if my initial direction is a bullish direction, what I can do is that on a 50 Fibonacci level here, it's neutral for me. For me, it's a neutral zone, right? I have to first calculate what is the range here, the pips, the pip range. So by dragging my trend line from this bottom here all the way to the top there, you can see the calculation on the side, the 5422, right? 5422. Therefore, of the 5422, I can quickly take on my calculator and say 5422. I must find 75% level of that, right? 5422, it's 4066.5, right? Or what I can do is just to avoid this one is a bit complex. I'll come back and say, you know what, my highest price level is 108.397. My lowest price level is 103.096. Therefore, what do? I find the difference. 108.397 minus 103.096. Therefore, the difference, I'll just multiply it by 100 just to make it in pip value. Therefore, I have 530 pips, right? 530 pips. then I must find 75% of that. 75% is 397 pips, right? Divided by 100, please bear with me, divided by 100 takes it back to this one. Therefore, I'll just add this number to my lowest price level, 103.096. So 103.096. Therefore, the highest price that I can sell on the 75% level, it's 107.0715. Therefore, I have to go look for it. Where is 107.0715? 107.07. Yeah, somewhere here, right? I can hope. Okay, I can sell the market above that level. Any level, any price above here, I can sell the market. It can be a retracement level, right? Therefore, I come back. Let me minus the 103.096. Therefore, all I can do is take the highest price, then minus it, minus the 103.096, which will take me to the lowest level that I can buy, right? 104.42125, 104.42. So I'm looking for 104.42, sorry, 104.42, 104, that is 105, 104.42. So any level below or just about 104.42, I can buy. I can buy, it's safe to buy here. So let me just shade them differently so that you can see them correctly, right? This is the Kotter's theory. It will make sense when you apply it and you see it working consistently, right? So what am I going to do? I'm going to, any level around this area, it's my selling point. It's my selling area right here. And here is my buying area. Any price. So what does this mean? It means that between the 50 Fibonacci retracement level and just above 78.6, I'm going to buy. Between the Fibonacci retracement level of 50, which is the Fib zone, any level above that, right, I'm going to sell safely, right? I can sell safely. Obviously, you won't sell here because this is the neutral zone. You'd want the market to go up to a reasonable level, and then when it gets to our exact selling area, we will sell. When it gets just a bit below the selling area, we will sell, but we can close at the 50. You see, so the 50 is a neutral zone. So look at, let's now identify what happened in the market. Remember now, this is the first movement, right? We won't look at that. We would only focus on this area. The area that we would focus is up to here. What happened in that area, right? So in this area, when one looks at it, where we supposed to sell, when the market opened, there was a gap, right? There was a gap, but price continued to go down. If someone had put a sell stop here, it would have been activated. Take profit, it's at the 50 level. Then the price goes up again, it gets closer to our selling area. But remember I said, any level above, you can sell. You can't sell on a bullish candle. You have to wait for the candle to complete, right? Then you can sell, right? So you sell on this area here on this price, you take profit there. You don't take profit here because you don't know if it's going to continue or change direction. You take profit there. Then look at what happened. Any level below the 50, it's safe to buy, but the highest, safest area is this one, right? So we would have bought here or maybe waited for the candle to come here. And then here is still a neutral area. When it goes up, we can buy here just, and then when you immediately when it gets to our selling area, look at here, how lucky, then we take profit somewhere there. Now, this is a candle that changes the direction, right? We'll talk about it. Even these two, it's an engulfing candle. It changes the direction. This one, it also changes the direction. It's a morning star, you see. So we'll get to the integrities of the candles later. But you can see selling area, major profit, right? And this, it's quite a number of pips. It's quite a number of pips. Look at it. How much? About 1,076. Right? Others would prefer to divide it by 10 or 100, but yeah, you can see it's quite a number of pips. It's a reasonable profit. So from there, it went up, it bought, back to the zone. See? So yeah, another thing what we can do is we identify, this is the supply zone. This is the supply zone, right? Where price loses its momentum, right? Where the bullish price loses its momentum, and this is the demand zone where price gains momentum, right? This one will focus upon it later, right? So you identify your demand and supply zones. You get to see what are they, and then now you get to focus on your raw price movement. Another thing that I discussed with you that I would like to show you guys on this chart as well is the trend line, right? Now, how you draw a trend line is that you focus from your lowest area to your highest area. In this way, this is a bullish trend line, right? I can just do it this way, but it's not how you do it, right? A bullish trend line. It's a bullish trend line. However, your trend line mostly, it bends. How it bends is because now there's a support on the trend, right? There's a rejection to show that the trend line is a bullish. Price starts here, it rejects on this level, doesn't break the trend line, continues above the trend line, comes here, slightly breaks the trend line, goes up again. But this is more like a rejection. Another rejection is here, another rejection is here. What is this? This is a bullish trend line, right? It's a bullish trend line. So a bearish trend line also from this area going down, you can see two or more candles, right? Therefore, forms a trend line, another, rejection, 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 all the way. It breaks the trend line, comes back to retest the trend line, and finally continues in a bullish direction. You see? So that's how you identify your trend line. It's seriously not difficult. Another one that you need to know is things like this, right? You have a bullish trend, it's going up, then it fell, it then rejects, then it goes further up again, right? This is nothing but a trend line rejection. So such things, you are going to apply them, and some of them, they are just going to come naturally once you have gained the skill. Trend line rejection is just you buy here, and then here you don't sell, you just wait, and then you buy here again, finally goes up, then you can sell at the top and close all your buys, right? So it's because you understand what you're doing, you know what you're doing, it becomes much easier when you have that, right? So cool. Back to the lesson. Now we discussed the quarters theory. I didn't want to go deep into it, but yeah, at least we know how to identify. So the major Fibonacci, the major levels to talk about, the major Fibonacci levels to talk about is the 50, the 61.8, the 38.2, the 78.6, the 88.6, the 122, is it 122 or 121? 121.2, and the 141.4, and then the 242 all the way up, right? Is it 121, 127, 127.2? Cool, 127.2. So these are the retracement levels that we are going to look at, right? So basically, these are the levels. Let me go to another chart. So on a daily chart, I can draw Fibonacci from the bottom, the top there, to the bottom, all the way here, or all the way there, right? From here to there, just to allow the trend line to kick in, the trend line break. Cool. How I identify my levels? This is the 100 level where we start, and where we end is the 0 level, right, in a bullish direction. So basically, I mean in a bearish direction. Basically, when we are having a bearish trend line, what you do, you drag your Fibonacci from the top to the lower low that, or the support that was created, right? So you have to identify it that way. And then the 50 Fibonacci level, it's here on the 50, right? And then between the 50 and the 61.8, it's a fib zone, right? Another one between the 50 and the 38.2, it's also a fib zone. So these fib zones, this mostly are the zones whereby price, it's starting to lose momentum, and all it does is just consolidating, nothing more than just a consolidation. So you need to watch them. You need to be careful. You'd buy here and hoping that it will break, and then it comes back down. You sell, and then it goes a bit down, it comes back up, all the way you buy, and it's like mostly it's an area of consolidation. So you must be careful of them, right? You either buy below the 38.2 or you sell above the 61.8. You can see this is just a liquidity region. You sell above the 61.8. I'd always advise that people should sell 50 pips above this one. So you can count how many are 50 pips. Let's say 50, 139, 55 pips. So you would sell somewhere here. Then you're safe. You can see selling here. When it goes up, it doesn't really kill you. Then you come down, then it goes all the way down. You're safe, I think. But we'll talk about this some other time, about how this is on the lesson of entry and exit in the market, blah, blah, blah. So yeah, then your 78.6, major retracement zone, 88.6, another major retracement zone. And above 88.6 towards the 100, this is where we begin to talk about the trend losing its momentum. Another levels, we can add the levels on a Fibonacci to, let me see, do we have, let me add the 127.2, just going to add it here, 1.272, 127.2. Just also pay attention on how I add the levels, right? 127.2. Then it's added. Another one is 100. you can see I have 127.2, 161.8. I didn't add 141, 261, 423, blah, blah, blah. You can see how I add them, right? Another tool of Fibonacci, this one is trying to identify how far is the trend going to go, right? For instance, it's called a Fibonacci expansion. You basically drag it from where the trend started, right? Let me just delete it. You basically add it from where the trend started to where the trend started rejecting its original direction. I'm just going to delete all these charts because they are really messing things up. Okay, USD/JPY is what we just analyzed. It's fine. Gold amount. Euro not amount. GBP/USD amount. Euro/USD amount. Nasdaq 100 out. Euro/USD out. FCHF. Cool. Sorry about that. Back to the lesson. Right. Fibonacci expansion 2. I'm saying from where the trend started to where the trend rejected to where the trend started continuing, or you can take it back because you don't know where the trend is going to continue. You take it back to where the trend started, right? This is here, a bit lower. Yes, this is here. So the levels on this one that you need to identify and understand are the 161, 61.8, 161.8, and the 100 level, right? I just want to make them more visible to the eye. Yes, I think you can see them. Any price above the 100 you can buy, but you can close, the highest price you can go is to the 161.8. Boom, it goes to that one. You can see the 161.8. Let me remove this other levels that are included. I'll have to add the tool again because I didn't deselect it. Cool, to where it started. So now you're trying to identify where is the price level going to, up to where is price going to move. So it tells us that price has to move all the way to the 161.8. So meaning everything that happens in between is just a trend line break. Look at it, we have a major trend here. Then we have a minor trend over there. Over there. So price went all the way to the 161.8. And then what did we do? We sold the market at the 161.8. See? So now you have the Kotter's theory. This is the Kotter's theory, right? This one is the Kotter's theory. But before the Kotter's theory, you can use the expansion tool to see if you are in a strong bullish direction or in a strong bearish direction. But this is mostly for positional traders, right? We'll talk about it more further in another video, like, because I don't want to bombard you guys with a lot of information that you still need to digest, right? So cool. So now we're still on price action. While on price action, sorry, hey, my word skills are becoming obsolete. So now another other things that we need to understand when we're dealing with price action are patterns, right? Patterns. So we have harmonic patterns, which are identified. We identify them through, that is why I spoke about the Fibonacci. So we identify them through the Fib tool, the Fibonacci tool, right? So the harmonic patterns, I'm just going to quickly brush through them because they deserve a special lesson on it. I mean, a special lesson on them. The harmonic patterns, they include your cipher pattern, then they include your bed pattern, include your double top, your double bottom, your heads and shoulders. They also include your triangles. They include your crab pattern. They include your shark pattern. They include your butterfly pattern. They include your Gartley pattern. They also include pennants. They also include flag patterns. You see, so there are other patterns in like that other people use to identify, like there's a house pattern, whatever. But mostly the ones that are okay are these ones. And they are much easier to identify. They're much easier to identify once you have learned, right? So with these patterns, the ones that I'm going to shade are the ones that we are going to use the fib tools to identify. In fact, all of them, but on the others, it's more advanced for others to understand. You need to have gone through the beginning parts of the videos. Double bottom and double, yeah, you can still use it just for entry purposes, right? Cool. So now, these also, like I said, they deserve their own lessons. So I'm just brushing through. You need to understand the patterns, right? You need to understand the patterns. So going back to the lesson, now, cool, do not shade, but it's okay. Okay, cool. Going back to the lesson, now other things that you need to learn about candlesticks. This one is very important, right? I know people, they derate candlesticks. They think candlesticks are not important. You need to learn about candlesticks, right? We'll talk about candlesticks later. There are different types. Just know that there are different types, right? Here I'm talking about price action candlesticks. Not just one candlestick, a bullish or a bearish candlesticks. I'm talking about the likes of a doji candle, and then I'm talking about the likes of an engulfing candle. I'm talking about morning star. I'm talking about hammers. I'm talking about your evening star. Talking about your seven soldiers. Like they're quite a lot, but obviously others we not. I even misspell soldiers now. Others we're not going to talk about to really emphasize because I don't see a use. You see, the ones that are most important for me it's your doji, your engulfing, your morning star, and to a greater extent your pin bar, right? Even your evening star is. The pin bar also is very important, right? So guys, these are what you need to learn. Let's quickly make a recap. Price action, demand, supply zones, trend line, bearish, whatever. I mean, trend line, bearish or bullish, you need to start, these are where the start and the end of the trend, your support and resistance. You need to also take into account technical indicators, your RSIs, your MACD, histogram, your EMAs, and also Fibonacci retracement tool patterns. You need to learn them as well, right? You need to understand them as well. So remember, as a trader, You can either scalp or I'll just say invest, right? Invest is those swing traders, right? Swing traders or positional traders. The reason why I wouldn't advise scalping is because it's a lot stressful, right? It's not reliable, and you can lose all your money in less than seconds, right? So investing, swing trading puts into account the psychology, right? So when you swing trade, meaning you leave your trades for a while, you build in the psychology and you also build in the skill. Then you can also figure out a pair, a forex pair, or a commodity, whatever it is that you are. You'll figure out its levels, its respective responsive levels. You need to understand what drives it, what moves it. When you do that, you will become better and better. I can give you an example. Earlier in the beginning of the year, when I was analyzing, let me look at this one quickly. Sorry about all of this. When I was analyzing, oh, by the way, we do plan. We plan when we trade. That's why you saw well there. When I was analyzing, I analyzed USD card. As you can see here, this is my analysis. I identified that my supply and my demand zones within the market was overexhausted here, meaning the demand has to kick in. You can see quite a few rejections. And at the same time, it is a bearish flag, right? Then my first target price was on this level, which was at what? The Fibonacci 50% retracement level, right? And then my highest price target was 1.33, right? As you can see, I also identified the high of the day, areas of price expected to change, expected to change as well, and price rejection. Then here I'm saying if the market breaks this price level, it must come down, then I will buy on the retest, right? So I did that just to, sorry, yeah, I didn't close quite a lot of things. Okay, just going to open it again. Man, did that, I bought, then guess what happened? What happened is first movement, immediately buy on retest. It shot up, hit the take profit, the 1.3200. And then what happened again? Okay, that was the first one. The second one, this is the second one, that was the third one. Hit the take profit, broke above the take profit, then reanalyzed. This is the 75% of the Cortez theory. Then I was hitting new target, take profit, hit the target, take profit, immediately rejected on the supply zone, back. What did I say? You sell anywhere above. Sell expecting to take profit there. You see, so that is what happens when you trade. It builds in the psychology. You get to understand, you get to see what is going on, and it makes things much more easy. There are other things that and now you see my girlfriend and everything, but there are other things that you need to consider when you're trading. You need to understand them, you need to follow them, and they build you as a trader, you see. So guys, I hope today's lessons helps. I'm very much pleased with how far we are going. If there are any questions, I'll expect them and I'll accept them. I'll save this one as well. Let me save it on my desktop as technical analysis lesson 2. Lesson 1 on technical analysis. Right. Thank you very much. See you in the next video. Thank you guys.